right now at 85 to 1, I think is what it's at. And during COVID, it shot up to 120. Silver has never been that cheap compared to gold. And I do believe that you are absolutely going to see the gold-silver ratio at 20 or less. So that means silver's value rises compared to gold's. The state of the economy is, I hate to say it, we're screwed. That's what it, you look at what every president has done, and they run on a platform, they're going to reduce the budget deficit, they're going to balance things, and then as soon as they get into office, they go exactly the opposite direction. Because the population likes it when you're handing out free candy. And that's basically what they're doing, is they're keeping the population appeased at the expense of I hate to say it, but you know, I do think that we are headed into a huge global financial crisis. In 1929, the stock markets were in a bubble. In 1966, stocks were in a bubble, and they worked their way off. The Dow bumped its head on 1,000 points in 1966 and couldn't break out until 1982. So stocks went sideways during a period of raging inflation. And so corporate profits and stuff went up during that period of time. And so all of the PE ratios and the indicators that tell you whether stocks are in a bubble or not worked themselves off. So we had a correction without a crash. But the first time it was stocks moving, gold was fixed, and real estate was not in a bubble. The second time it was stocks, real estate was not in a bubble in 1966 to 82. And then we had the NASDAQ, the tech bubble of 1999-2000. Again, stocks in a bubble, but not real estate. And then it was both, you know, from 1971 to when gold became free trading, it was only gold moving that caused this correction in the gold to like the Dow gold ratio, the stock market to gold. It was only gold moving. This time it's both. Gold and the markets are moving. We've got, you know, in 2008, the global financial crisis, stocks had already been beaten down from the 1999-2000 tech bubble popping. And so stocks were just above, the stock market was above fair value. It never was allowed, Ben Bernanke papered over all the cracks, and it was never allowed to go to undervalued so that we built a solid base again. What they did was they just, as everybody knows, created tons of currency. They exceeded my wildest nightmares because I had written all about this and about his response to the next crisis in my book that came out just months before that, before it all happened. But this time, stocks are in a bubble, bonds are in a bubble, and real estate is in a bubble. And these are bubbles of historic proportions. The only way that you can measure the stock market that shows it not in the greatest bubble in history is PE ratios. All of the other measures, the Buffett indicator and different ways of measuring it, all show it in the greatest bubble in history. Real estate, same thing. And then bonds, you know, we had a bull market in bonds from 1980 until just the past couple of years. So bonds are also in a bubble.
40-year bull market in bonds, right?
Exactly. And so when these, you can't have something go into a bubble where it's out of whack with the rest of the economy. Permanent. It can't stay there permanently. Something has to happen. Either the economy has to grow to match it, and that's not very likely, or there has to be a crash, a correction. And so we're going into this next big crisis with $38 trillion worth of debt, and with the Fed's balance sheet already expanded so much. In a 2015 update to my first book, I wrote that you know, the next time that they do QE, they're starting it from a base that is already so high. There was $800 billion in the bank reserves and in base currency. Base currency is the cash in your wallet plus bank reserves. And it peaked at 9 trillion. And so we're off the rails.
Major market crashes rarely come without warnings hidden in past cycles. In 1929 and again in 1966, stock valuations detached from economic fundamentals. Inflation surged, growth slowed, and markets entered long stagnation. Then came the dot-com bubble in 2000. Technology stocks soared beyond logic while the real economy slowed. Historically, when one major asset class overheated, others stayed grounded. But today's environment is unusual. Multiple markets are stretched simultaneously. Whether looking at PE ratios, valuation indicators, or investor sentiment, the signal is clear. Bubbles don't stay inflated forever. They burst. And the bigger the bubble, the harder the fall.
Central banks are still buying. It definitely has not peaked. In this last run-up, it was basically Asia and and India pushing the gold price, and it was physical demand instead of all the gambling on the commodities exchange and the LBMA. And so it's telling me that we're getting closer and closer to a crisis, and it's impossible for bubbles to just go on forever. So we're at a period of time where they are trying to kick the can down the road, but with things at the extremes that they are at right now, I'm expecting something within the next year or so. I'm actually surprised that we got through October with no big event. October is always that spooky month.
Always something, a black swan. Loves October.
Right, yeah.
Right?
What separates the present from previous crises is scale. Stocks are at historic highs by almost every metric except narrow corporate earnings measures. Real estate prices have soared beyond affordability in many regions, from the US to Europe to Asia. And bonds, once considered safe, have experienced a 40-year bull market, leaving them dangerously overvalued as rates rise. This is not a single bubble. It is an everything bubble. Stocks, property, and bonds all priced far above what the real economy can justify. When multiple pillars of wealth inflate together, they also collapse together.
The thing I wrote when I updated my first book in 2015 was that they're going to need to do the same percentage increase, not the amount of printing, the QE, but the percentage increase to try and stave off anything. But remember, like I said, in 2008, the stock market wasn't in a bubble. That was a real estate problem only, and it affected the stock market. This time, it's real estate and stocks, and it's turning out that everybody was expecting commercial real estate to do a correction. Well, that has all been put off with forbearance and rewriting the mortgage agreements, and that is all over with now, and they can't really kick that can down the road any further. I'm really expecting something horrific, actually.
The U.S. alone carries over $38 trillion in national debt, and growing. Central banks expanded money supply at record speed following the 2008 crisis and again during the pandemic. Cheap money hid the cracks instead of repairing them. While markets celebrated the surge in asset prices, ordinary households struggled. Rising delinquencies on mortgages, auto loans, and credit cards tell a darker story beneath Wall Street's optimism. Search trends reveal desperation, debt relief, missed mortgage help, returning car to bank. The real economy is strained, while markets pretend everything is fine. That imbalance cannot last.
Yeah, the number of repossessions of cars has just exploded, and then the number of people searching, internet search terms for help with mortgage. Basically, the search terms for. Do you remember during the 2008 global financial crisis? There was jingle mail. You put the keys in the envelope, you mail them back to the bank. The house is theirs. So all of these search terms for things that nobody should be searching for how to consolidate debt, manage their mortgage payments, how to give their car back to the bank if the economy is healthy. It's not healthy. The underlying economy has, the stock market completely detached from the real economy a couple of years ago. And everything is like fake right now.
Traditionally, gold reacts to economic stress. But this time, demand surged without Western speculation, driven instead by Asia and India, accumulating metal quietly and steadily. Meanwhile, Western investors have been selling into strength. This shift hints at a transfer of wealth from West to East. Another key indicator, the gold-to-silver ratio. Historically around 15:1, it has recently exceeded 80.1, a level signaling extreme undervaluation of silver. In the 1980 metal spike, both gold and silver rose together as confidence collapsed. As governments continue printing and debts escalate, precious metals often become the ultimate safe harbor.
It was nothing compared to the final months of 1979 and the first month of 1980. It was an insignificant move. Actually, in my book, The Great Gold and Silver Rush of the 21st Century, I quote several articles from Time magazine back then, and there was an economist from the 1800s. His last name was Giffen. I can't remember his first name right now, but he proposed that there's a certain class of goods, Giffen goods they're called, that where price-demand balances don't work. It's exactly the opposite. So as the price goes up of something, usually anything, there's less demand because people they look for a less expensive alternative. Gold and silver violate that, and we just saw that with this run-up. This run-up was largely caused by physical demand in Asia, Australia. It was interesting in the United States. We weren't participating yet. In fact, there was a lot more sales than buys, and refiners in the United States got all clogged up.
I've been hearing in the month of August a lot more selling than buying because gold shot up. That's what I'm hearing from the bullion dealers.
Yeah, they think they're taking pride, and the people that are selling are going to regret it one day. They really will. It is sad to see the East buying and the West selling because it's a wealth transfer that is going on. And we are nowhere near the top of the precious metals markets. And the things that tell you that are things like the Dow gold ratio, the gold-silver ratio. In 1980, when gold and silver peaked on the same day, the ratio between gold and silver took 14 ounces of silver to equal the value of 1 ounce of gold. And that is about the natural ratio is that there's about 19 times more silver in the Earth's crust than there is gold. Silver tends to occur more up toward the surface and gold is deeper. And so when we would dig it up back then, the reason that the gold-silver ratios averaged about 15 to 1, somewhere between 13 and 16 to 1 all over the planet, was simply because if you've got a certain number of coins in circulation, you got 13 of these silver coins for each one of these gold coins in circulation, it's the free market. Yeah. Finding this equilibrium, the exchange rate. And right now, at 85 to 1, I think is what it's at. And during COVID, it shot up to 120. Silver has never been that cheap compared to gold. And I do believe that you are absolutely going to see the gold-silver ratio at 20 or less. So that means silver's value rises compared to gold's.
Governments and central banks have spent years kicking the can forward, restructuring loans, suppressing interest rates, and injecting liquidity at every sign of trouble. But delay is not prevention. Commercial real estate stress remains unresolved. Retail investors are stretched thin. Global markets sit one shock away from unraveling. October, historically notorious for financial surprises, passed quietly, but silence can be deceiving. Analysts warn that the next downturn won't be confined to one sector like 2008. It could hit everything at once. When confidence breaks, markets correct fast. The question isn't if, it's when.